Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. As I'm attending the brilliant Samola Hill climb in Knysna this weekend, a world-class motorsport event, I have cars on the brain. And I've got to tell you, there is not much spark right now in European car manufacturers. And I'm not just talking about the fact that they are obsessed with building electric vehicles instead of internal combustion engine or ICE vehicles. Coming into this year, things were already looking really bad, and tariffs and recession risks have only made it worse. Back in September last year, I released a Supernatural Stocks podcast that focused on the impact of China on the global automotive sector. I looked at local companies like CMH and Motus and the risks that I felt they were facing, while touching on the European manufacturers as well. Here we are roughly 6 months later, and the opportunity is now there to see how this has played out. We've had a detailed earnings release from CMH, and by the way, it wasn't good. We've had a trading statement from We Buy Cars. That's my preferred play in the sector, and that was good. And we've also seen a number of updates from European brands, including Volvo, by the way, a company that is vastly reducing its dealership footprint in South Africa. Now, of course, all of these companies are tied together at the end of the day. They are just at different parts in the value chain. Volvo's reduction in its dealer footprint sets the tone for this update. The concerns that I raised last year have only become worse. In investing, you ignore trends at your absolute peril. And one of those trends is, of course, electric vehicles, a hill that Volvo has decided to die on. So we may as well start there. Volvo's advert for their EX90 is one of the best ads I have ever seen, across any brand in any sector. It speaks brilliantly to the DNA of the Volvo brand, which is safety, of course. And as a parent, it punched me in the gut and it filled me with emotions all at once. That is the power of great advertising. It's just such a pity that you now need to be super wealthy to even consider the car being advertised. Plus, you need to be in a country with suitable infrastructure for EVs. Unfortunately, this all but rules Volvo out from meaningful participation in emerging markets. The South African dealer footprint is dropping to just 7 dealerships, as the Volvo range is now really only suitable for developed markets and some urban pockets, particularly wealthy ones, in emerging markets. Long gone are the days of affordable entry-level Volvos. To be fair, 7 dealerships is probably a fair reflection of the underlying buying power of South African consumers these days. Quite honestly, I wouldn't be surprised to see it drop further, and I also wouldn't be surprised to see a similar trend at competitors, including major German brands. When last did you see a brand new Audi on the road? I digress. If you're going to look at Volvo, don't make the mistake that I made. It's horribly, horribly easy to make, because if you look at Volvo Group, that's volvogroup.com, then you might be surprised by all the pictures of trucks and not much else. I went and dug through those earnings, I saw the nasty drops in revenue and operating cash flow and all of the stuff you would think about, all before getting to a segmental report that was devoid of anything to do with cars. This is because Volvo Group is devoid of anything to do with cars. It's only commercial vehicles. Goodness knows they aren't doing much better than cars right now, but that's a different discussion point. Instead, what you want to look at is Volvo Car, as the name suggests, which trades on Nasdaq Stockholm. So there's some more potential confusion for you there because the word Nasdaq exists in Europe as well. We are so used to looking at US-based stocks that the sheer variety of European stock exchanges becomes somewhat confusing, especially when they share names with US counterparts. Anyway, having finally found a set of quarterly results that included pictures of beautiful electric vehicles instead of just trucks, I can tell you that those images are probably the only highlight. Retail sales units were down 9%, wholesale units were down 19%, and revenue was down 12%. That was enough for group earnings before interest and tax, or EBIT, to be down a hideous 59%. Cash flow from operations came in at minus 6 billion Swedish krona. At least that's better than minus 12 billion in the comparable period, but still very much in the red. Predictably, the focus on EVs is doing wonders for Volvo's market share in that segment of the market, and it is hurting the overall financial position of the group. Sure, they may enjoy the highest EV penetration rate of any of the premium manufacturers, but that's like winning the award for being worst dressed. It's funny, maybe you did it on purpose, But it's not a sign of success, it's mainly just a sign that Volvo has practically given up on anything that is not an EV. Unsurprisingly, there's now a major cost reduction plan underway, including in collaboration with Geely, the majority shareholder, ironically, a Chinese company. Volvo is targeting double-digit reduction in expenses that sit outside of cost of sales, and that's a lot of overheads that they need to take out the system. It really says something when there's a slide in the results presentation about how the EX90 is the World Luxury Car of the Year 2025, yet the preceding slide notes that Volvo is no longer even giving revenue guidance for 2025 and 2026. Talk about building the wrong product. The Europeans really have brought this upon themselves. We now go from the sublime to the ridiculous. Volvo makes genuinely impressive cars and they still can't get it right in this environment. So then what chance does Stellantis have? The model range varies from the magnificent but horribly overpriced Maseratis through to generally underwhelming and often quite ugly SUVs designed for Americans who aren't famous for having the highest quality standards when it comes to vehicles. The net result of this mishmash of brands and vehicles is a 9% drop in shipments and a 14% decrease in revenue. And guess what? They've suspended 2025 full-year revenue guidance. This company doesn't even have a CEO right now, with the process to appoint a new CEO underway. Although they are obviously blaming tariffs at the moment, and that is clearly a huge problem, it's really just another issue to add to a long list of self-inflicted problems. Stellantis has been messy for a long time, which is why the share price is now only slightly above where it was 5 years ago. That's during COVID. Over 12 months, it's down 61%. But as a sign of how bad the entire market is, and to give that performance some more context, Volvo is down 53% over 12 months, almost as bad as Stellantis over that period. We have to give a dishonorable mention to Volkswagen. Volkswagen's revenue in the first quarter of this year increased by 2.8%, which makes it sound like they should be getting a round of applause relative to their peers. Alas, operating margin plummeted to just 3.7% and operating profit was down 37%. Even though unit sales were up 0.9% and revenue was up, there was so much pricing pressure in the market that even Volkswagen barely stands a chance here. When you look through all the numbers, their gross profit has come under a lot of pressure. The automotive sector is a tight margin game at the best of times, with European players having worked on an assumption of having pricing power versus Asian brands and then building their business on that basis. Perhaps Hyundai and Kia laid the groundwork years ago for consumer acceptance of new brands from the East, but it's certainly the Chinese that have now scored the killer blow. I can't tell you where this all ends for the car manufacturers. All I do know is that I'm not investing in any of these dips, and I don't plan to change that. Similarly, I don't want to be anywhere near their value chains, as there are far too many companies that were built around an assumption of European automotive dominance. From logistics through to components, it's going to get ugly out there. This is why I am not invested in CMH, the local company that is riding on the success of Suzuki's passenger vehicles and Ford's power in light commercial vehicles. A lot of the other brands are facing difficulties at the moment, with CMH looking increasingly like a terribly outdated business based on rapidly changing consumer trends. We recently saw Mete, a components manufacturer, branch out into used spares with the acquisition of AutoZone. Why? Because they want to make money from the existing cars out there, not just the hope of selling new ones. A brand-agnostic approach based on parts feels safer right now, certainly versus supplying a major manufacturer a very specialized plant for one vehicle. It still feels safer for me, even though AutoZone had landed up in business rescue thanks to a broken balance sheet. I think the underlying business is probably okay, which is why Mete acquired it out of business rescue. Mete has lost half its value over 5 years, and again, that's versus a COVID base, so that story is still just too speculative for me to want to be involved. I think they're making a good strategic play, but the legacy business is a problem. My position in the sector is way simpler than any of these. We Buy Cars, a company that does what it says on the tin. They buy cars, any cars, and then they sell them. They don't care about the brand. They're not selling new cars at all. They just want to churn vehicles at a fast rate through their showrooms, helping the 10 million South Africans who own cars, that's a CMH statistic by the way, to buy and sell those cars to one another. It's a simple and elegant solution to the risks of private sales, which is why it is so popular. And although headline earnings per share was heavily impacted by the new shares issued before the listing, earnings themselves, headline earnings, that's growing strongly. The We Buy Cars share price has more than doubled in the past year. Although that makes me somewhat nervous, it is also a long-term position for me. I'm happy to keep holding it, and I'm especially happy to stay far away from anything else in the automotive sector. Well, almost anything else. I am also long Zeda, that's Z-E-D-A, not the agribusiness Z-E-D-E-R. Zeda, the one I'm invested in, is a car rental and mobility company that trades on a very, very low PE multiple. And although car rental is a competitive minefield, as certainly confirmed by the recent CMH release, we are talking about a trailing PE of 3.3x at the moment. Look, that can always get ugly if earnings drop. Suddenly that PE will feel like a value trap. But for now, I'm willing to take my chances with it, and it's a small position. We Buy Cars is my fighter in this market, and Zeda, a nice supporting act. We'll see how it works out. So far, so good. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.